podcast. This is Ron Costa, where we put you on the map, broadcasting live from the Mapable USA studios in Las Vegas. And today, as usual, we're going to continue our talk about opportunity zones. And for that, we bring in Vicki Hutchmala from the QOZ Marketplace. Vicki, how are you doing today?
I'm doing outstanding today, Ron. Beautiful day, Friday, started the weekend. What more could we want? And we have an excellent guest with us today.
Well, one of the great things about Opportunity Zones is, of course, it's nationwide. It's all new, and people are always going to conferences and meeting industry professionals and players in the market. And when the last one, when we went to the Opportunity Zones Expo in Las Vegas, we had the pleasure of meeting our next guest. So let's bring on David Sillaman from Eazy Do It Opportunity Zone Funds. How you doing, David?
I'm doing great, Ron, Vicki. How are you guys doing today?
Great. It's always good to talk opportunity zones, right? It's the hottest topic in real estate, it seems, these days.
Hottest topic, hands down.
Yeah, and you in particular are seeing a lot of these deals come through because you're actually helping people create the opportunity zone funds with your company, Eazy Do It. Is that right?
Yes, sir. That's what we do. We set up turnkey opportunity funds for high net worth individuals, real estate clients, business owners looking to capitalize on the program. And that's what we do is we set up everything from the legal to the financial to the web, marketing, branding, presence, everything, A to Z, soup to nuts, turnkey, and we do it, we feel better than anybody else. And we love talking about the subject, and we're passionate about it, and love helping people.
So and it's not like it's not like you just started this. I mean, you've been doing these funds. You've got a lot of them under your belt already. You mentioned before you're doing these for individuals and business. These are real high net worth people, right? These aren't people who are just like throwing something to the wind and saying, "Yeah, I want to start an opportunity zone fund." These are people who are seasoned developers, I'd imagine, or people who have a lot of experience in real estate or business.
All of the above. Yeah, it's
wow.
Everybody that we deal with is all seasoned people, businesses, usually businesses that are either very high startup, where the yield curve to cash flow positive and EBITDA positive is a small yield curve, or they're already EBITDA positive between 5 and 250 million as a business, and they're looking at using these opportunity funds as a way to expand what they're currently doing.
Yeah, and before we get really into this, can you tell our audience about your background and how you kind of got started in this?
Sure. My background is actually pretty eclectic. Prior to Opportunity Zone Funds, I was doing change management and private equity raises for businesses. I'd come in, I'd help change people, process, product. I saw back in May of last year, I got pulled into a real estate hotel project, created an Opportunity Zone Fund. Very shortly thereafter, ended up being the second fund in the country open, and then have since gone on to develop approximately a fifth of all the funds out there right now.
Yeah, that's impressive. That's a lot of stuff out there. And you mentioned before a lot of these funds are starting on a very low amount, for example, but some of them are also just putting out press releases and saying, yeah, we're ready to go, but they haven't really raised their money yet. So you talk about it being an easy project. Is it really easy to start an opportunity zone fund? I mean, it's easy, I guess, to self-certify, but how easy is it to get successful to the point where you're actually raising money?
Well, here's what people don't regarding the self-certification, what's not being talked about is all the other steps that have to go along with it. The self-certification is really, in my opinion, one of the last steps. It takes a quality business plan. It takes identifying a quality investment that the fund is going to put the money into, because not only are the investors on the clock, but so are the funds. So even if you're successful in getting a fund set up and you're successful in raising, you still are on a time clock. The underlying investment is it quality. Are investors going to find that, hey, yeah, you set up a fund, you're putting it into something, and are you going to actually generate a return, or is it going to end up pissing the money away? Opportunity funds are a quasi-hybrid animal I look at. I say that, okay, we've got a tax program that's rolled into quasi-treasury with SEC guidelines on how to go about doing the raise. And so setting up an opportunity fund, it's really something that you've got to have a multifaceted understanding of what type of reg offerings that you can do according to the SEC, the type of investors, the number of investors, the amount of investors, accreditation standards. There's a lot of different how you're going to go about raising, the amounts that you can raise. All of that has already been well established by the SEC from the Investment Act of the 30s and 40s on how to go about raising private equity. And that's what all of these opportunity funds are, is they're all technically a private equity raise. They're all considered ultra high risk investments. They have no prior performance history whatsoever, and they're all private. None of them are actually gone out and have gone either penny or public as of yet. They've got the ability to, and that will come, but right now they're all private raises. And so anybody that's going to set up an opportunity fund has to be cognizantly aware of what you can and can't do, because the SEC can turn around and disqualify the entity, disqualify the raise, which would disqualify the opportunity fund, even if you self-certify. Doesn't matter. If you didn't raise right, the SEC can come back and say, oops, sorry, you messed up. And so we work with clients. We educate and consult with clients on how to structure these things correctly. There's two types of structures to opportunity funds. You've got the partnership structure, which is predominantly the bulk of the market right now, and then you've got also the ability to do stock-based structures. Our preference, believe it or not, is actually the latter, the stock-based structure for opportunity funds, which is completely counterintuitive.
Yeah, why is
what
that?
We see in the marketplace right now. Well, stock-based funds they provide a number of things that partnership-based funds don't. Number one, it's a lot easier with a stock-based fund to structured as a portfolio investment vehicle and to make multiple investments. As a investor into it, I'm not coming into a partner into the fund as a partner into one investment. I would be coming in as a shareholder, and my gains would be diversified. Something, a keyword that's not being talked about much, but diversified or diversification, because the fact that the fund is acting as a portfolio fund. That's number one. Number two, when you take a look at what stock-based structures can do, there are other alternatives with stock-based structures that make for a cleaner exit strategy at the moment. Something that every opportunity fund should be well aware of and absolutely beginning to think through now and identify how an exit strategy is going to play into the development of an opportunity fund. Stock-based funds, and I'm not saying that it's not impossible to get a partnership-based fund vetted, listed, but with stock-based funds, there's actually private securities markets that exist where a stock-based fund can get vetted, broker-dealered, listed, the due diligence, underwriting, and the risk held and carried by an exchange market. And they exist. We're actively pushing out opportunity funds through this process to be on an exchange market to create an exit strategy for the investors in the fund, where after a hold for 12 months, at that point, then as long as there's demand in the exchange market, then they can just simply put a sell order in and exit out of the opportunity fund at any point in time. The exit strategy in stock-based funds aren't necessarily contingent upon the ability to do a refinance in the future, the way that a lot of these real estate-based funds are. Stock-based funds, partnership-based funds can do the same thing, but stock-based funds, it's just an easier route where they can offer a preferred stock with a buyback option, which gives a structured buyout for the investor at a 10-year period. Most stock-based funds have a tendency to be more business-focused versus real estate-focused, as most real estate funds, it's always been, partnership structure for real estate. Same thing applies to opportunity funds as it stands right now, but with stock-based structures, most corporations are most large-scale businesses that are between 5 to 250 million in EBITDA that are in these opportunity zones that are expanding. Most of them are C Corps. So it just makes it easy to set up a fund. It makes it easy to manage a fund. It makes it easy for a fund administrator to handle everything, and it makes it easy to put together an exit strategy. The trade-offs are, especially in real estate, is when you start looking at the ability to create liquidity passing through. And stock-based funds, you can still do distributions, you can still do dividends, but it's the second type of structure that's out there. And then you've got a third type that's a little bit of a blend of both, which is a REIT. Those are far and few between. But those are pretty much what we do, is set up these opportunity funds. We work through structural issues with our clients, and we help get them to market and put them in front of investor groups, be it broker-dealers, RIAs, family offices, and we help them raise, and hopefully they'll be successful.
So when someone comes to you and says, you know, what can you do for me? How do you approach it? Do you determine what kind of project they can go in, where they want to invest? What's the first step aside from what you just described in creating the fund? Before you get to that process, how do you determine what your first step is?
Well, for us, we have an onboarding client questionnaire that we walk every client through to understand what their needs are, to understand what their goals, their objectives are, what their investment strategy is. Do they already have an investment already lined up? Do they know their numbers on that? These are all preliminary things that we try to gather prior to setting up an opportunity fund for a client. We, believe it or not, we say no more than what we say yes to.
Oh, I can imagine that. There's a lot of people that seem to assume that this is an easy process. Here's my money, and I'm going to get a tax deferment, and that's it. But the details are incredible, and especially if you don't know the details and set them up correctly, as you just described, then you're spinning your wheels.
Absolutely. It could have the last thing that a company wants to do is raise money, think that they're being successful, come to find out that the way that they raised was invalidated, and they have to turn around and, especially if they've already spent the money, then they're really in a catch-22. And if not, if they haven't spent it, then they have to give the money back to the investors. Now the investors, their time clock is already done.
Yes.
And so now you've got upset investors. You've got a fund that didn't meet the criteria to be able to raise correctly. They didn't, follow any of the process procedures, documentation, or anything, and it just causes a lot more problems in the long run. And when you take into consideration that this is a government program, when you look at the history of most government programs, go back to the 80s under the Reagan tax cuts, it took almost 3 years for that to really kind of get solidified. When you look at the HARP program under Obama, same thing. When you look at the EB-5 program, same thing. So with this being a brand new program, it's something that the devil really is in the details, and in understanding what you can and what you can't do, and how to properly set one of these things up, whether it is a partnership fund or whether it's a stock-based fund. Just being able to understand what you can and can't do, and the right way is critical.
Well, and things are, the rules, the regulations, the whole process is evolving. It's kind of an infant industry, and that puts a little a glitch into it, because what's working today may change tomorrow too, in terms of rules and regulations, criteria from the Department of Treasury, the IRS, and all of that. So you kind of have to be ahead of the curve.
You do have to be ahead of the curve a little bit. The way that the way the guidelines read right now, if you take a look at the last 2 rounds of tranches and regulations, very, very heavily strong language in partnerships and explaining through a lot of that. They're really, though, if you look back at both sets of regs and everything that's been in the market ahead of time, I would challenge anybody to find 5 questions relating to stock-based funds.
Right. Yeah.
The only issue that we've really had was in the initial set of the second. We had the initial set that came out, the first 4 pages in June.
Right.
Then we had the real first set of guidelines, the real tranche, 179 pages that came out altogether between both. We've got, the first round that came out in October, and that was very much almost all LLC related, a lot of language. In the second round, the only thing that it really did was to clarify for businesses saying, hey, listen, you can take advantage of this. You can even use this for your startup expenses. And they did away with the ruling of the 50% of the revenue earned had to be generated from within opportunity zones to now having a set of criteria of which it's very easy to meet. The easiest is just saying that 50% of your employees' hours worked are in opportunity zones. So they've really have kind of removed the barriers for business. And since raising capital around stocks, that's been around, like I said, since the 30s and 40s.
Right.
Businesses have been doing it now for years and years and years and years and years with ultra success. So on how to go about doing that, especially with stock-based funds, there's a super straight line where, in my mind, I think a partnership-based fund kind of zigzags a little bit because there's so many nuances to it.
Right.
I look at, because this is so new, the safest bet is to walk the most established line at the moment. Let the dust settle on the program.
Right.
And then evaluate.
So I guess that means you set up more corporations than you do partnerships?
We definitely do. We do our fair share of corporation-based funds, C-Corp-based funds, but we also do partnership-based funds. We do all of them. We even have the ability to do REITs, although we haven't done one yet, but we can.
Uh-huh. So do you work with individuals who say, okay, here's what I have, here's what I want to do, I've answered your questions, and so you create a fund for those individuals who then go out and find their investors, or do you have this person and that person and a couple and put them all together into one fund?
No. These are one-offs, sponsored funds. Mm-hmm. What really sets us apart is not only do we create them, we support them, we educate, but then we also got dedicated funding resources that have partnered with us with exclusive rights where they've got first rights of refusal. So everything we develop, they get to choose whether they're going to stick money into it or not.
Right.
Our process of developing makes it very easy for anybody with money to vet and do due diligence on these opportunity funds.
So you're kind of a one-stop shop.
It's a turnkey operation. Easy do it. Our name is
that's the name of it, right?
is Eazy. Average turn time for us to get a fund to start to finish through our entire process is about 14 to 21 days.
Oh my goodness!
It is an incredibly quick process for us. We've
that is fast.
We've been at it since the very beginning, and we've got what we think is a systematic approach. We've got really great resources, attorneys, finance people, CPAs, treasury agents, IRS agents, both active and retired, TIGTA agents, both active and retired. So we've gone and placed an immense amount of emphasis on over documentation, over transparency, because I look at these things and I say that when you have, as an investor, when you set up an opportunity fund, you've got to think like the investor for a second. None of these funds have any prior performance history.
Right.
Not a single one of them do. Every last one of them are at the exact same blank starting point. You might have the sponsor that has history. You might have the fund manager that has management history. But the fund itself has no history of saying, we've generated a 8, 9, 10% return consistently for the last 7, 8, 10, 12 years. You don't have that. So when you've got a brand new marketplace and you have no performance history in these things at all, it's an ultra high risk bet for the underlying investor with the capital gains. Because what if they put money in and then the fund doesn't perform, and now they don't have the ability to pay the tax come 2026.
Well, exactly.
So we looked at that, and our methodology was to say, how do you create credibility when you have no performance history? And there's really only one way to do that. It's through an over and abundance of documentation and transparency. It's where you can give an investor something more than the minimum required, because these are all private equity. Keep that in mind. All of these opportunity funds, whether you're setting one up or whether they're existing, they're all private equity. They're not public. You're not going on to like a Merrill Lynch account or anything else like that and buying your way into an opportunity fund that way. They're all private. And so with that being the case, like I said, they're all ultra high risk. We looked at it and said, how do we take something that's private and how do we build enough credibility behind something brand new in a brand new program besides the benefit, the tax benefits? But how do you get an investor to say yes? And that's what we looked at, is we said it's going to come down to due diligence. It's going to come down to underwriting of the fund, underwriting of the investment. And so how do you do that? Well, you do that through an overabundance. And so we took the FINRA 1022 checklist, which is what most broker-dealers in the country use to, say to anything that they're going to vet. We require this 65-item checklist. And we took that checklist, and that's what we build these opportunity funds around. And then we package everything up, and so that way when an investor, be it a family office, an individual, a broker-dealer, if they want to see something, we've got an entire package ready for them to vet and underwrite at the snap of a finger. And so it makes getting the yes a lot easier. It makes getting the investments a lot easier, because when you look at where they're at in the market space, this isn't a one-trick pony. This is one of those mindsets that you've got to kind of think as a fund that, okay, if you're going to set up an opportunity fund and you're going to capital raise, this is a lot like being an owner at the Kentucky Derby. And if you want to win the Kentucky Derby, the easiest way to do it is to own all the horses in the race. So you have to think through what those horses are. It's not just John, Jane Doe. The IRS said that there was $6.8 trillion in capital gains last year. 2.4 were corporate capital gains. The other 4.2 were individual capital gains. So where are those individuals at? Well, they're with RIAs. They're with family offices. Sometimes they're by themselves, and they're just Googling it, they stumble across it. Maybe they hear a podcast. They come to a directory. But they're also with broker-dealer money. They're with traditional outlets. Take a look at Bank of America, for example. Bank of America in the last very short period of time has partnered with not one but two different opportunity funds to help flow some of their wealth management clients. So we're seeing that right now is such a prime time. The market space to set up a fund, I mean, when you talk about the economics of this, really put this into perspective for a second. If you look at most of the major directories that say these are funds and these guys have come out and they've listed and they're raising capital. If you look at CoStar's group, Novogradic's group, and CSHA, you've got about 137, 147 funds, $33.5, $34 billion. But you've got the Treasury's own statements that they're anticipating anywhere on a low end, 150 to 250 billion. And Ron, Vicki, if you guys were at the Vegas Expo, you heard some other numbers as high as $1 trillion flowing into opportunity funds in 2019.
Yeah, it's mind-boggling.
You couple that with that this is a yearly wave. You've got an inverted supply-demand yield curve. This market space needs opportunity funds more than it needs projects at the moment. Projects existed before the program. They're going to exist after the program. But the opportunity fund is the bridge. It's the funnel for the money to go into the project. And it's that bridge that the investor walks through first. And until the marketplace is balanced, you're going to have an overabundance of demand and not enough funds. And that's where the opportunity is at. There's a time, place, and season for everything in life. If I told you that, hey, I was going to promise you this really great high yield on this investment, and all you had to do was put money with me, and I'm going to plant tomato seeds in the dead of winter in the middle of Antarctica. It's not the right time, place, or season for a harvest. But when you look at what opportunity funds are, it's not about the project. It's not about the dollar at the moment. That's existed before and it's going to exist after. Right now, the opportunity is being able to get to market and setting up an opportunity fund, capitalizing on the fact that the market is disproportionately in a yield curve at the moment, and ride that where it's easy access to capital until the market balances itself out. See, when we look and we forecast 2-3 years from now, as the marketplace begins to balance itself out, it's going to become a lot harder for opportunity funds that are new to come into the market. The investors that are already out there most of these investors are high net worth accredited investors.
Right.
They have yearly capital gains. So knowing that somebody's got yearly capital gains, if I open up a fund today and they put money into my fund today and I perform well, there's a good chance that if I'm going to do a subsequent round, like a round B, or if I'm going to set up a subsequent fund, that same investor is going to continue to do business with me. And so it's going to be a
True.
lot harder for new funds to get into the market in the next 2-3 years. And so
Yeah,
right
and plus
now,
I was going to say, plus at that point, you're showing a record of success, which no one has at this point. So that's the key difference here. If you start it now, you have a record of success. It's only going to get easier down the line when you can show, hey, you know what, I performed here, and I can perform in the next one.
Yep, you are exactly right. And that's why timing is everything. And the timing right now is and I see a lot of this where you've got a lot of projects out there that are looking for money. My recommendation is if you're a project and you're out there looking for money and you're listening to this podcast, call us, set up an opportunity fund.
No question.
Why would you, I don't understand why as a project I would solicit another fund and fall under their underwriting criteria as a fund to my project if I can just open up a fund and control the whole thing myself.
Exactly correct.
Why not control the underwriting, control the investments, control the fund, control the management, control the terms and conditions, and do the same point that you're at with soliciting a fund. And when you look at most projects that solicit these funds, most of these opportunity funds, you're going to be hard-pressed to find a number of blind pooled funds. There's probably less than 7 out there in the entire market space, and they're flopping like a fish out of water right now. You look at most of the funds that have raised money that are successful because they already had an identified project. They're not out there looking to deploy funds into a new project yet because they don't have the excess to deploy yet. Most of them don't.
Yeah.
That doesn't come until just a little bit later on down the road.
Well, what's interesting about what you're doing, what I like about what you're doing is you're putting all your expert people in-house. So whatever is necessary at whatever stage of creating the fund, using the fund, or dealing with the project, you have the people right there around you who can do what needs to be done. So you're not farming it out to this person or that person, and there's where you have control of your project and you can relatively guarantee success.
Yeah.
That is correct.
And another thing, David, I think, let me just see if I understand this correctly and what you're kind of proposing here, where if I'm a developer here and I have, let's say, 100 acres that I want to develop in an opportunity zone fund, you're suggesting that this developer should start his own opportunity zone fund rather than look to maybe sell that property to an existing opportunity zone sponsor or fund manager.
So
am I getting that right?
That's exactly what I'm saying.
Yeah, go on.
Right now is the time to set the fund up and just capital raise around the development for the project. Mm-hmm. That's the time that the way that we see it right now. You'll have some developers that just want to exit and just liquidate, but the real developers should see the writing on the wall in this program, the economics behind it. This is something that's going to impact, if done right, this will be either the biggest tax giveaway or the biggest catalyst to change in the country.
Right.
In
every
arena, be it real estate, be it business, every single solitary sector could be impacted. We're doing funds for franchising. We're doing funds for blockchain. We're doing funds for transportation, for gold mining. I mean, energy, oil and gas, everything under the sun. All of it applies to opportunity zones.
Right. And then before the podcast started, you had mentioned that you're looking at maybe 3 out of 4 of these funds being attributed to businesses versus real estate. And that's an interesting take on it as well, because I think a lot of people who are listening to this right now probably would have thought the opposite.
I'll tell you what, here's where businesses, the sustainability of this program is not real estate. It's not. Prior to opportunity zones, we were in what was widely recognized as a declining real estate market. Now in real estate and opportunity zones, you've got hyperinflation that's beginning to balance that out a little bit. But when you look at every real estate deal, every last one of them is capped. They're all capped. If I build a 300-unit development, I'm not going to get a 301st rent. Now, as an investor, a business has no ceiling on its earnings, which means there's no ceiling on the returns.
Great point.
When you look at businesses, this will impact every sector in America. Everything could be impacted by opportunity zones, opportunity zone funds. I can tell you that we've had immense discussions, direct discussions with the Trump-appointed advisor to the SBA, educating them, working with them, helping to derive what would be an educational program for business owners to understand the power that they've got with these opportunity funds. Every single solitary business owner in America should be looking at opportunity zone funds. And there's 1,000,001 creative ways that opportunity zone funds could help. 1,000,001 creative ways. But the sustainability won't be real estate. It will be business long term.
Yeah, that's an interesting point on that one. But like right now, they recently just put out the second round of guidelines and opportunity zones, and I think what we could take away from this podcast so far is the fact that really businesses are going to be a bigger thing than real estate. And do you see the opportunity zone program changing over the next couple of years as well to kind of just continue to drive that point home?
I think it will. I think it will. I can see this program if the legs get like anything healthy, right? Anything healthy should grow. And in that growth, you always have a period of discomfort. If you've got kids, you don't feed a baby a newborn steak, right? And just like that baby, you don't throw out with the bathwater when they're going through their teething phase and they're crying and they're up all night. It's the same kind of concept. As the IRS, as the Treasury, as the government, as they begin to analyze the impacts and the effects of the existing legislation with how it's being done right now, I think that we'll see, because we're already seeing it. Keep in mind, this is a bipartisan supported program. It's already through 2037 for the last year that you can invest into, with a 10-year hold period, extending the program, closing it out at the moment through 2047. We're already seeing discussions where they're talking about doing extensions to the program. I could see where the rolling, I could see that when you look at, if I put my money into an opportunity fund today as an investor, I've got a tax bill that's due 2026. To me, the way this really makes the most sense, if they convert that into a rolling deferment. So if I put my money in 2019, my bill is due 2026. If I put my money in 2020, if I hold it for 7 years, my tax bill will be due 2027. If they do that as a rolling deferment, then they'll maximize the amount of annual investments into opportunity funds. And at the end of the day, it makes the most sense for the IRS and for the federal government, because when you think about what these do, this is an economic stimulus program is what this is. This creates jobs. It spurs real estate development. It spurs business growth. But at the end of the day, it spurs the economy. Sure. And if this goes well, then it behooves the IRS and the Department of Treasury to actually want this thing to continue, to want this thing to go well, because they're going to make up for it. The 15% haircut that the investor is getting, I guarantee the IRS is making up for it in the longer run than looking at a 15% haircut on the individual basis across the board.
Mm-hmm. I agree.
I agree too, and they kind of can't help but have to extend it, as you said, rolling it down the road to the future, because why would you want to stop something like this that actually is helping the economy in general? That doesn't make any sense.
And you don't want to stop it.
Exactly.
You want to continue to keep putting the maximum pedal to the metal, get the program rolling out there in a big way. Now, what we'll see is I think that the ideology of self-certification, although it's good right now, it opens the door for an immense amount of intentional and unintentional fraud.
Correct. Absolutely.
And I could see where that component of it could get changed in the future, but it would grandfather everybody in up to that change. So it doesn't have the impact on do I or don't I set up a fund today. It's just going to have an impact on tomorrow. All the more reason to set one up today.
Right. Right.
Right, and to set it up properly and have it properly vetted. Again, that's why we created the Opportunity Zones Authority as well to help vet and make sure these funds are set up right. But David, before we go and close this out, I got one more question for you. You know, we work in a lot of commercial real estate. We see a lot of commercial guys who are looking at the 1031 as a tax deferral strategy. Do you see that as well? I mean, what would you say to somebody who is considering a 1031 versus a Opportunity Zone fund?
All right. Well, in my humble opinion, I think that Opportunity Zone funds and this legislation is going to have a significant long-term impact with 1031s. I think 1031s in some cases will still have its place, but I don't think it's going to be nearly the way that it has been. I think that when you look at the benefit of the 1031, what you're really getting is it's the step up in basis, the fair market value at your death for your heirs.
Right.
With the 1031, every time you roll a 1031, you've got new intermediary fees, and you're never getting your principal and you're never getting your interest out of it. So this is a way for somebody today. I'll give you a prime example. I had a conversation with a gentleman, and I'm not going to name names, so I won't get into too much details, but I had an amazing conversation with this gentleman, ultra high net worth investor, probably has close to 100 properties between hotels and residential. But he's also got a son that has a disability, and he's looking at where he's at in his life and age, and he's looking at his son, and he's saying, I need to be able to set something up now and move all this stuff out of the 1031, cash out, pay my depreciation recapture and whatever gained, roll the difference into the opportunity funds, and then, you know, put together a plan for his disabled child in 10 years.
Got it.
And so I think that what you're going to see is you're going to see a lot more of that. I'll tell you, 1031 companies, if they're smart, not only will they work with clients for the existing 1031 program, but they'll also work with clients on rolling them out of 1031s and into opportunity funds as investors. And then you save them as a client. You continue to keep the rapport, and you still have them for the future. I could see this is going to have a deep cut for sure to 1031s.
Yeah, and we're going to have
out eventually over time.
Well, I don't know.
Given the fact that opportunity zones will continue into the future, I mean, more people will then invest in an opportunity zone as opposed to doing a 1031 exchange, that it's just more viable?
Like I said, 1031s will still have their place with some families, okay? They've been doing them for years. They've got more depreciation recapture than what they actually would have gained. Any number of scenarios would want to keep somebody in a 1031. But I think that this is going to have a deep cutting impact into how expansive the 1031 program is in the long run. Keep in mind, I mean, we're 2019. This program, as it stands for opportunity funds, right now closes out 2047. There will more than likely be an extension, if not more than one, to push the program at least to 2057, if not beyond.
Right.
That is a lot of time for this to really get its legs, to mature in a right way, for it to overcome the 1031 in a big way.
Yeah, we're going to have a 1031 guy on a future podcast, so that should be interesting to hear what he says. But for now, let's say we got a guy on who's listening to this right now. He's a developer or whatever. They want to start an opportunity zone fund. David, how do they get a hold of you? What's the best way to contact you and get this thing going for them?
First thing is they can go to our website, and it's www.eazydoit.com. That's EAZYDOIT.com. Our services are flat rate. We're not paid on the raise, so we're not a broker-dealer, all right? We've got our online inquiries on there, all of our contact information. They can directly inquire at info@eazydoit.com. They can directly contact me, connect with me on LinkedIn, any number of different ways to reach out to us. The easiest way is just to go to our website. We've got some forms on there that if you're interested, you can kind of fill out, and one of our team members will give you a call, and we'll we spend anywhere between, we promise a free hour consultation with each client. So we'll answer their questions, help educate them, give them the nuances of what they can't do, the ins and outs. And if it's a fit, it's a fit. And if not, then so be it.
Yeah, no, that's great. And easydoit.com, who's your friend at GoDaddy? Man, that is a great domain name. That's incredible. That's really strong.
Well, I'll tell you, I will say this. Starting next month, we're going to be releasing ozfunds.com.
Wow.
As an educational website for business owners to go to get information. We'll have some stuff directly, hopefully from the SBA. We're working through that, like I said. So it's not live yet, but hopefully by the end of the month, in the next 15 days, 16 days, it should be. And that'll be ozfunds.com as well. And so for any business owners, they can simply inquire on there that way also.
Excellent.
Yeah, how great is it that if you had a client today to start an Opportunity Zone fund from scratch, you can theoretically have that Opportunity Zone all ready to go before this new website comes online, right? It's that fast, right?
We're that fast. The last fund that we did for it's called I'll name this fund. I'm very, this is a very beautiful fund. It's the second venture capital fund in the country to open.
Okay.
It's called the VerteOZ, VerteOZ.com. It's a venture capital portfolio fund. We built that for the former head of portfolio analytics for Fannie Mae.
Oh,
great.
wow.
Almost $1.5 trillion in assets.
And we're going to put all these
fundamentals, strong background.
Yeah. We'll put all these funds and links that we're talking about today in the show notes. So if anybody just comes to the website and sees the podcast, they can just click on one of those links, go right to the fund, and get there.
Perfect.
Yeah, it's all good. So David, thank you so much for taking the time out to talk to us today. I know you're busy and you're traveling, you're everywhere out there. I love your posts on social media. You do a lot of stuff, really great stuff in the industry, and we're happy to have you on the podcast today. We really thank you so much.
Well, thank you guys so much, Ron, Vicky. It was a real honor and pleasure, and I look forward to doing it again. I wish everybody out there all the success in this Opportunity Zone space. Take advantage of it. It's a once-in-a-lifetime opportunity.
And thank you, Vicky, for being on the call with me as well. This is Ron Costa, and you're listening to the Mapable USA podcast. You can go to mapableusa.com for the website and scroll down to see all the syndication sources out there. And subscribe to the one you like best so you never miss another program that you're listening to right now. And just like David was a guest here, there's a guest tab. Click on that, fill out the form, and we'll see about getting you on a guest as a podcast as well. So once again, thank you, everyone, for listening. And we'll look back on another Mapable USA podcast coming up real soon. Have a great week.